My name is Errol Zeki, and I'm the Chief Executive Officer at Sasfin Wealth. So on behalf of Sasfin and our panelists, I would like to welcome you to this live webinar. We've hosted numerous of these webinars during the lockdown in a series we have been calling Around the World in 21 Days. Clearly, we came up with this name quite early on in the lockdown, and quite a lot has changed since then. We've covered numerous topics through this series, and today's webinar is titled Navigating the Equity Markets Maze. Just to say, we have deliberately kept the audience for today's presentation smaller and more exclusive, as it's going to be a little more technical to some of the previous events. If you'd like to pose any questions to our panelists, please post them via the chat function. We will identify and combine the most common questions and respond to them after the formal part of the session. As with the previous webinars in this series, this is not a COVID-19 talk per se, but clearly given the moment the world is in right now, it is going to dominate quite a bit of the content. I'd like to remind you that our business is fully enabled to operate remotely, so please do contact us via the normal telephonic or digital channels. And please also visit Sasfin's content hub at sasfin.com to see recordings of our webinars and a lot of other content that we publish on a regular basis. But that's enough from me to introduce our panelists today. Firstly, we have Mike Hayworth. Mike started his journey in investment research at UAL Merchant Bank in 1985. Thereafter, he worked as a sell-side analyst for various stockbroking companies before taking on the role of head of investment strategy at Netcore Securities. For the last decade or so, Mike has been consulting on investment strategy, process, and systems to a number of stockbroking and asset management houses, including Sasfin. So at Sasfin, Mike is responsible for creating and maintaining Sasfin Wealth's international and domestic macroeconomic themes and adapts them into investment themes, which ultimately drive the sector and style rotation within the global equity model portfolios. We also have Alec Abraham. Alec is a senior equity analyst at Sasfin. He's been doing primary research across a broad range of industries for over 26 years, initially at international debt rating agency Fitch Ratings, or IBCA as it was called at the time, and then as an equity analyst at SG Securities, which is a division of Societe Generale. So Alec has been recognized in a number of financial surveys, including the Financial Mail Analyst Review, which is done on an annual basis, and primarily for work in healthcare and retail sectors locally. And then last, but by no means least, we also have Nick Dakin. For those of you who were on our Beyond Global Wealth webinar, Nick was there as well. So Nick has been with Sasfin for probably around 5 years now as a global equity analyst before joining the Cape Town team as a portfolio manager. He's also intimately involved in the management of our global equity fund. And his particular interest really is around innovative and disruptive global companies that he believes is transforming the world. So with that, I will hand over to the team. Alec's going to kick us off with a South African view or story, after which Mike and Nick will expand this to the sort of global macro and equity environment. So with that, over to you, Alec.
Great. Thank you very much, Errol, and welcome everybody. Good afternoon. It's a fact that the South African GDP growth rate has been tracking below the population growth rate for a couple of years now, in fact, almost 8 years. What does that mean? That means that South Africans have been getting poorer. That's a bit of an issue because our economy is very much a consumer-driven economy. If we look at the tertiary sector, which covers retail, the retail sector, telecommunications, and financial services, that makes up about 70% of GDP. Now, businesses can generally survive with 1 or 2 bad years, slow years. But when this persists for almost a decade now, even good businesses start to struggle. And what have they done to survive? Firstly, businesses have been cost-cutting. Cost-cutting is a good thing, but at some point, if you cut too much, it starts to impact your operational capability and go-to-market effectiveness. In recent years, what we've also seen more of is that companies have been right-sizing their capacity and capital allocation to match the shrinking addressable domestic market and poor outlook. Some of them have tried to export the capital. They've been buying offshore businesses. Unfortunately, that hasn't worked particularly well for most of the companies, but the reasons behind that are for a different presentation altogether. At the same time, the public sector investment in the economy has also been pushed out by the growing need for social support, and now business support as well, and a higher interest bill during this post-Moody's downgrade and pandemic period. The investment actions of low public and private investment in the economy have reduced the country's potential growth rate. And with government's limited fiscal ability, the private sector must come to the rescue. And the only way government can encourage investment in the economy is by addressing the many structural roadblocks that are preventing private businesses from investing in this economy. Just trying to go to the next slide. There we go, bit of a delay. In this slide, what I've tried to show is some of, not all, of the key roadblocks that we have in the economy, structural weaknesses. What I've also tried to do is separate them from between the ones that are obviously going to take many, many years to resolve, and some that I think can be relatively quickly resolved and make a big difference to the economy. Firstly, government needs to address our poor roads, rail, electricity and water infrastructure to create a base for the economy to grow upon. The only way we're going to get past the structural unemployment, skill shortage and poor productivity in our economy is by improving the education system. Clearly going to take many, many years. But in the meantime, government has got to be decisive in dealing with the ineffective and wasteful public sector and SOEs and the rampant corruption and lawlessness in the economy. Some possibly quicker wins that we can get are mainly regulatory, and so they can actually change with the stroke of a pen and a little bit of political will. Some of the key roadblocks are the onerous land reform and property right policies. Also, government has got to do more to get rid of excessive regulation on business, BEE regulations, and labour regulations. The impact of all these structural roadblocks in our economy raise the uncertainty in decision making, they raise the cost of doing business, increase prices and introduce inefficiencies in the economy. They stifle SMEs, small medium enterprises, and innovation. They also encourage mechanization rather than job creation. And all this necessitates an expensive social grant system, which we can't afford, and which has been funded by ever increasing taxes, particularly personal taxes, as the corporate tax base shrinks. Now, I believe the COVID pandemic has accelerated South Africa's march to the Rubicon for the second time in history. And I think we can make a huge difference here in the country's trajectory. For some reason, I feel the need to start waving my finger when I'm talking about this. Right now, the government can do one of two things. Either they can use the pandemic to get buy-in to rewrite the social compact between government, labour and business to proceed with the very difficult structural changes that the economy needs, or they could waste the crisis, which I believe will usher in the end game to structural decline and ultimate global obscurity. Which are they going to do? Just to try and get clues, we'll look at the performance of the government during this lockdown period. While the early response to by government to the COVID pandemic was quite laudable, with the introduction of the lockdown and mobilizing business support measures, as this crisis has progressed, policy has become absolutely laughable. We've had policy confusion, contradictions, and ludicrous measures. Now, in my mind, that highlights the ongoing factionalism and infighting within the ANC and the strength of the corrupt old guard within that organization. And I fear we're probably going to mess up this decision as well, like we did the first time. So what does that mean for the future of South Africa and the JSE? I think the pandemic will change behavior that has a lot of long-term ramifications. First and foremost, I think it'll increase the demand for precautionary savings by households, and even in corporates as well, looking to improve their solvency levels. The problem is the increase in aggregate savings that will come at the expense of consumption and fixed investment, which is going to hamper GDP growth. Government's fiscal crisis and the added cost of the SOE guarantees and the COVID packages, I believe, seal the fate for GDP growth in the future. And with no structural reforms expected on the horizon, because I don't believe the ANC has the political will, I expect that this year we're probably going to see about a 5 to 10% drop in GDP, and then quickly return to our subpar below 2% growth in GDP every year into the medium term. In this scenario, the perceived value that a lot of SA Inc. stocks on the JSE present, I believe, are nothing more than value traps. Because the only way to unlock that value is in a cyclical upturn, and that I don't see on the horizon. Meanwhile, on the other side of the world, you've got IT-enabled companies that are changing the way the world works, how consumers operate, how businesses operate, what people spend their money on. IT and growing nationalism around the world is also driving regionalization of production. The problem is the JSE doesn't offer investors very much scope to participate in companies that are making these significant global changes. And we can't put all our money in process. The emerging market also, I believe, will benefit less from global growth in future cycles with this increased nationalism and regionalization. So as we approach the roulette table again, there's two choices. Either we can invest in South African businesses that are operating their businesses as if they're going out of business, or invest in major international companies that are investing literally global country GDP's worth of capital in R&D and growth initiatives. The picture I've painted over the last 10 minutes really has informed our investment stance at Sasfin. And what it's done, we've first and foremost sought returns by backing the many offshore companies that are shaping global trends. For South African funds, though, I believe it's more important now than ever before to incorporate bonds in the asset allocation to capture income with a greater degree of certainty over dividends. We're also considering private equity investments to capture the potential pockets of growth that we'll find in the economy. Much of this growth will come from small, unlisted companies that either identify opportunities, address government deficiencies, or overcome regulatory roadblocks. A good example of that is Vantage Capital's mezzanine financing of Louie Vuitton, which they've recently exited at great profit. For the South African equity allocation, though, at Sasfin, we've maintained a relatively low exposure to SA Inc., particularly discretionary consumer companies and those with a large emerging market or African exposure. Rather, we've preferred to put our money in established majority offshore earners like Process, Anglo American, Bidcorp, and it's actually stood us in good stead. We've also included some defensive local earners, such as Transaction Capital, Pick n Pay, and Vodacom. Finally, we urge you during this time not to make wholesale changes to any portfolios. It's a very, very uncertain time, very volatile, and we've got very poor visibility on what the long-term impact of this virus is going to be on markets and on economies. So I'll leave it there, and I'll hand over to Mike, who's going to share some of his thoughts on exactly what the impact on markets will be from the coronavirus. Thank you very much.
Good afternoon, everyone, from a sunny late autumn Highveld. I want to talk through some of the major global macroeconomic issues. And there's so much going on at the moment, and it's moving at such a pace that I would like to just try and focus on a couple of global themes which we think are dominating the narrative at the moment, and then look into some of the detail around that. That should take around about 10 to 15 minutes. So if we start with about eight, we think, key themes at the moment at a macroeconomic level globally. Clearly, the COVID-19 pandemic is front of mind. And the issue really is we've seen how fast all of these economies have locked down. And importantly, when we're trying to assess whether we're going to get a V-shaped recovery or what shape the recovery is in fact going to be, we need to first of all see how we locked down in the first place. And the fact that the globe sequentially locked down tells you that it's going to sequentially unlock. And on top of that, there will be staged recoveries in that sequential unlock. Both of those components tell me that we will not have a V recovery. It will be a U at best, and hopefully not, we don't get a relapse and land up with a W. And if things carry on for an extended period, then obviously we have an L. What's happening at the moment is that we're getting long-term damage to both the travel and hospitality industries. Global supply chains are being fundamentally repositioned at this point, and it's going to start affecting global trade and the way companies structure their supplies. We're seeing major priority changes taking place at a government and public sector level around healthcare, and obviously that has impacts on the likes of budget allocations. If we look at the global imperatives that are happening at the moment, we're seeing that there's altogether a new focus on public healthcare regimes, and this makes me immediately think of our national health insurance. After the COVID-19 experience, I think we will see around the world that there will be an entirely new emphasis on one global, but two regional and domestic public healthcare systems. From some of the satellite images that we've seen, there's been clearly a big change in terms of pollution, and I think this has probably reinforced that we can do something about climate change, and it can actually have quite a quick impact on what we're seeing, particularly from space. So my sense is we've probably had a bit of a turbo in terms of many of the regulations and legislations around climate change. Terrorism, with social distancing, I think terrorism as we know it was probably quite difficult to enact, and I suspect that the terrorism will start taking new types of forms, and I'm thinking along the lines of AI and robotics and the likes of drones, etc. And clearly cyber sensitivities will be front of mind in all of this as well. The demographics have certainly, the differences in the demographics have been emphasized by COVID, and particularly with the aging side of it, and how are we going to start seeing changing income patterns, changing consumption and savings patterns. All of these things are becoming new global imperatives. In the global environment, we're seeing a major bifurcation taking place. Clearly, many economies are now starting to turn inward. I don't know if you saw just yesterday, the UK increased its import tariff for vehicles by 10%. So immediately what's starting to happen is many economies are looking to try and protect their domestic output and employment by raising tariffs. That was absolutely inevitable. We're also seeing from a difference between services and goods trade around the world that we expect services to expand, particularly on the digital platforms, while goods are likely to become more regional, less global, and perhaps more even domestic in that sense, as many economies turn inward. The geopolitical risks, I suspect, have been elevated through all of this. The US president certainly hasn't really lifted the trade war. Certainly the trade tariffs are way higher than they were in the beginning of 2018. If you look at the COVID accountability issue, the US is now starting to point fingers at who's responsible for COVID and who should actually start paying. That's going to be a very interesting conversation over the next run-up to the elections, the US elections in November. And of course, there's a cybersecurity issue around the whole US trade relations as well, which has now been taken up a notch. Remember Brexit? Well, it's still around, and I suspect that many of the divisions have probably been actually exacerbated by the COVID risks, and Brexit still in the background will have to be brought to the fore, and clearly both Europe and the UK get damaged not only by the COVID, but particularly by the delay in the whole Brexit negotiation. It looks to me that the Middle East tensions were escalating before COVID became a global problem. That has not gone away, and the way the US is talking at the moment certainly exacerbates the geopolitical risk in the Middle East as well. We will see fun and games in the next 6 months in the run-up to the US elections, and certainly President Trump is doing his level best to up the ante in every possible way at this point. And the other big issue, of course, is the support for multilateral organizations, particularly coming from its biggest participant, which is the US, is now looking very wobbly. If we look onto other areas, the debt levels around the world, the Bank of International Settlements, which is a central bank, has been warning about the very high debt levels around the world for more than 2 years. Those debt levels are starting to climb at an eye-watering rate at the moment. The lower interest rates is obviously helping this along at a fierce pace. On top of which, there's a lot of rescue funding going on around the world from a fiscal point of view. All of this is creating financial repression, and the very low interest rates are hurting investors and savers and helping out governments so that they can just raise their debt levels even higher. So the very high debt levels are going to get a lot higher in the next few years. And what it tells you is that you're probably going to find that the policy interest rates are going to stay very low, because once you've got very high public debt levels, you clearly can't have very high interest rates. So my sense is that we're going to have very low interest rates, ultra low interest rates for an extended period. By that, I mean probably up to at least 5 years. So the very low interest rates, with all the uncertainty, with a lot of the volatility, we're battling for returns, both from a fixed interest perspective, and when we look at our equity returns, they've been eroded, one by lower earnings trajectories now, and now more and more solvency issues. So that's creeping in, and again adding to the financial repression where we're struggling to find returns. We have seen the dollar strengthen dramatically the last couple of months, really on euro-dollar shortages and on very much money market shortages, particularly in the States, and just the general risk off. So we've seen the dollar strengthen dramatically. I think that will start to ease in the second half of the year. We've seen big changes in the nature of work. Most of us who can are now working from home with remote access. New work patterns are changing, flexibility. I think you're going to find company structures change pretty dramatically. We're going to see much greater use of AI right through the digital kind of platforms like financial services, healthcare, increasingly retail and entertainment. And these digital platforms, I think, have just got a major turbo in terms of application at a global level. And all of this, because the damage that's being done by the lockdowns to many of the businesses around the world, is that there's going to be increased merger and acquisition activity. Your deferred dividend payouts, you're going to get buybacks have been taken out now as well, and you're going to get a lot of increased use and manipulation now of balance sheets and restructuring of balance sheets, which is going to come through. Thanks, Alec. So if we look at the COVID picture, this is from the World Health Organization, that gives you on the vertical axis cases, on the horizontal axis it's the number of it's the number of, the time. And the various countries and regions are shown there. You can see in pink that Europe is starting to come off the boil from a total cases point of view. The Americas are still expanding. Eastern Mediterranean still expanding, and Southeast Asia is still expanding. Africa, of course, is very small, but that's also expanding. Thanks, Alec. Importantly, when you look at the daily confirmed cases, that's starting to come off the boil. So we had a very rapid rise in March. It topped out in April, and it's certainly in some of the major economies like the US. It's high, but it's certainly starting to come down now. It's high in the UK, but also starting to come down and coming down pretty rapidly in Europe. If we look at global GDP, the revisions are coming through thick and fast by the week now. And the graph that I put up there on the top left-hand side is global growth estimates by the major multilateral organizations. There's the IMF, World Bank, OECD, and then there's the Economist Intelligence Unit. The OECD and World Bank are very slow in changing their forecasts. The IMF's already gone negative for this year, as well as the Economist Intelligence Unit. And in fact, those forecasts are actually getting downgraded by the month as we go along and new information comes through. The important thing to understand here is we've never been here before. We've never seen this. We've never seen drops like this. The kind of GDP drops we haven't seen since the 1930s. And the kind of numbers that they're talking about vary between 15 and 30% per quarter in second quarter. And obviously, the longer the lockdowns go on, that rate of GDP destruction continues into the next quarter. So monetary policy at the moment is expanding at an unbelievable rate. And it's really there just to keep the markets functioning and to keep the credit lines opening. Monetary policy has never been able to, on its own, support and stimulate economic growth. The fiscal support that we're coming through is absolutely stunning and way bigger in both monetary and in a fiscal perspective. The support that's coming through is way bigger than it was in 2008. Which gives you some sense of how seriously the authorities are taking things. From an inflation perspective, from a fiscal point of view, I mean, what we're seeing with these massive fiscal relief funds that are being put forward, this is literally just filling an income hole. This is not about stimulation. This is about filling an income hole. What we see with the inflation outlook at this point is that inflation is very low and pretty stable from an expectation point of view. Clearly, some economies are going to have some deflation in the short term, which might give a little bit of room for lower interest rates. But generally speaking, inflation looks like it's going to stay very low for at least the remainder of this year and next year. We'll see what a lot of this income, a lot of the monetary support and fiscal support does a little bit later on, see how much more comes in. We've got very low interest rates. The picture on the top left-hand side there shows you that all the rates are essentially on the deck. We have got some negative rates. There's a lot of discussion about negative policy rates at this point. And I see that the UK has just issued a bond at 0.3 basis points negative. The US is resisting it at this point, and you're going to get lots and lots of terrible distortions coming out because of these negative interest rates. So low rates for a long time is one thing. Negative interest rates takes things to an entirely different level. Obviously, these very low rates keep the debt levels rising at an eye-watering level, and it also sustains financial repression. So we're finding that there's a lot of manipulation, and of course with the central banks buying along the yield curve, it's holding down the yield curves as well. So you're getting short-term and long-term yields being flattened out, which is aiding and abetting the government funding, but hurting investors and savers. Thanks, Alec. So if you look at the central banks on the top left-hand side, you can see what the total assets of the BOJ in red, and so the BOJ in blue, and in red the states, the Fed. In the last couple of weeks, central banks have put in about 5 trillion into the global economy. The Fed alone has lifted its balance sheet by 2.8 trillion in the last 3 months. That was more than it took them 6 years to do, starting in September 2007. So the balance sheet in the States is about 7 trillion. That's about, at this point, 32% of GDP. The BOJ's balance sheet is over 100% of Japan's GDP, and the ECB's balance sheet at this point is about 40% of the euro area's GDP. So the numbers are big and swelling, and it doesn't look like they're over either. A lot of effort has been put in by the central banks to keep overnight liquidity flowing, and that the plumbing, certainly in the overnight markets, has been working pretty well. The central banks have responded quickly, kept the repo markets going, and kept the foreign currency swap lines going. Both of those made things really look exciting in February, but they've calmed the markets down in that area. And of course, the repo markets are telling us that there are collateral issues out there and solvency issues. If we look at the monetary support from the Fed, it does look, just listening to Powell talking in the last couple of days, they will carry on doing what they need to. And my sense is that the Fed's total assets are going to carry on rising over the next year and a half to probably well past 10 trillion. So we're now starting to look MMT in the eye, which is modern monetary theory, and in simple terms, it means that central banks start buying directly government debt and start financing government debt, and that takes us into an altogether new realm of economics. From a fiscal point of view, the fiscal side has really climbed in and reacted very quickly. On the table on the left there, you can see Japan's put in 21% of GDP, the US 14% of GDP at this stage, and they're talking about quite a lot more as well. If I listen to Nancy Pelosi, South Africa has put in. The big issue with all of these numbers is that they sound good, but that's the one point about it, but it needs to filter into the system very quickly. One of the problems we're finding in South Africa is it's been announced, but the disbursements, the feed and efficiency of those disbursements is very delayed. And of course, the more delayed it is, the more damage there is in the long term to these economies. It's easy to kill a business. It's not so easy to build one. So the access to funds at this point will come from the multilateral development funds. The IMF is now very active. You can expect higher taxes all over the world, particularly at a personal or wealth income tax levels. Prescribed assets in countries like South Africa become altogether more talked about, as do capital controls. So the big issue now with governments now sucking more and more money out of the economy, you get the moral hazard issue, and you've seen this crop up with the likes of Business Rescue, with Comair, but yet they're looking to try and support SAA, and you've got Ryanair, it's a private airline, not getting support, while companies like Alitalia have never made a profit, are getting government support. So there's moral hazard in all of this. Who do you support and who don't you? So the fiscal side is creating some real disparities and some moral hazard. Thanks, Alec. This is just a picture of what the dollar looked like. So you can see the dollar jumped very quickly in February and March, and that was really because of what was happening in the global markets and this massive risk off, and everyone starting to look for dollars. One, clearly there was a shortage of dollars in the US because the repo market started to tighten, so that also raised the game. And you also had a massive tightening and this global hunt for dollars was also manifest through the euro-dollar market. Remember, most of derivatives are traded in dollars, most of commodities are traded in dollars, and most international debt, 70% of it is traded in dollars. So the dollar demand is represented in those graphs there, and the central banks climbing in with their swap lines, etc., have calmed that down. It hasn't brought it down materially, but we do think that the dollar will start coming off the boil and start to weaken, which is going to be important for emerging market currencies like ours, and also for commodity prices because they are dollar denominated. Thanks, Alec. And then just in summary, I've taken you on a really quick burn around the global macroeconomic picture. But to summarize, the collapse in output has not been seen since the 1930s. We're looking at something of the order of 15 to 30% of GDP in a quarter, and the more quarters it goes on for, the more damage it's going to do. The output trajectory is clearly absolutely uncertain at this point because we've never seen this. We don't know how it works. We don't quite know what permanent damage is coming out of all of this. And we do know, though, that the path out of this is inversely correlated to the COVID new infection rate. Essential services have been functioning well. The production side of the economy starts to come out in stages. Clearly, different businesses can come out at different speeds. But certainly the travel and hospitality areas of the global economy are going to be the last to recover. Exceptional monetary and fiscal policy, way bigger than we've ever seen in 2008, has been pumped into the system, and it looks like it's probably have to be pumped in for at least the rest of this year and possibly well into 2021. The massive increase in national debt, we're going to see the kind of numbers coming out of the states at the moment. The states will have a budget deficit of something like 18% of GDP, and its public debt levels by the end of 2021 will be 108% of GDP. These are numbers that are starting to look like Italy, which gives you some sense of, in some of the big economies, how massively this debt is actually increasing. There will be permanent changes to the economies, no question, changes in structure, changes in their global outlook, and changes in the nature of the way people are consuming. The global risks have been amped up around the world, and particularly related to the US-China relations. The trade-weighted dollar, from what we can see, looks like it's going to start to weaken, which is going to help emerging markets and commodities. And we do see a major expansion of corporate financial engineering to tidy up balance sheets over the next 18 months. Thank you very much for your time. That's a very quick look around. I'm going to pass it on to Nick Dakin to talk through the equity side, the global equity side. Thank you.
Thank you, Mike. So just following on from what Mike and Alec have had to say, I'm going to be discussing what the thematic must-haves are, as well as how we think you should be positioned from a global equity perspective. So I want to start off by briefly discussing why you should invest globally. The graph on the screen shows the value of 100 Rand invested in the JSE All Share versus other global markets over the past 5 years. So at the top, we have the S&P 500 in the US, where your 100 Rand is now worth 213 Rand. In the middle, we have just global markets in general, which is at 173 Rand. And all the way at the bottom, we have the JSE All Share that has only managed to get you to 107 Rand. There is some Rand weakness at play here, but it does give you an idea as a South African investor how much money you would have made by taking your money offshore. Next slide, please, Alec. So many investors still believe that they can access the same investment opportunities offshore by investing in the JSE, as most of our big listed companies earn the majority of their revenue overseas. The graphs on this slide show why this isn't the case by comparing the performances of JSE companies versus their global peers for tech, alcohol, luxury, and oil industries. On the top left, we have technology. So if you had invested 100 Rand into Amazon 5 years ago, you would now have 900 Rand. In the middle is Tencent, which would be worth around 415 Rand. And at the bottom, Naspers, your 100 Rand is turned into 270 Rand. On the bottom right, we have oil. So Sasol and Royal Dutch Shell, as well as BP. BP and Shell, you'd have around 100, 110 Rand. So not great. But if you'd invested 100 Rand in Sasol 5 years ago, it would now be worth just around 20 Rand. More importantly, from a forward-looking perspective, returns on the JSE are likely to remain weak given what is unfolding in the country, as Mark and Alec have alluded to. Next slide, please. This leads to the topic of my presentation today. One of the primary reasons for the underperformance of the JSE versus global markets is that the long-term investment trends and themes, which are driving global growth and changing the world, are difficult to access on the JSE. There are three main global trends taking place: urbanization, a growing and aging population, and a rising middle class. On urbanization, people are moving to the cities. Since 1950, the world's urban population has risen by almost 6 times, from 750 million to 4.2 billion people in 2018. Around 50% of the world's population lives in urban areas. This is predicted to rise to 70% by 2050. The population continues to grow and age. The World Health Organization expects the global population to continue growing rapidly and reach around 11 billion people by 2100. At the same time, global life expectancy will also continue rising and is expected to reach 77 years by 2050, up from 70 years in 2015. And the middle class is growing too. However, the outlook for this trend may change somewhat due to COVID. These three trends are the driving forces behind 7 key long-term investment themes that we have identified. Firstly, 5G, the Internet of Things and big data. 5G Internet is finally being rolled out now, albeit very slowly. It is going to be an incredibly important technology, as it will be the enabler of the Internet of Things, providing the foundation for communication between billions of different connected devices, connecting everything from cars to robots and even babies' nappies. And this will result in massive amounts of new data being created. Automation, robotics, and artificial intelligence. The fourth industrial revolution is being powered by smart automation and robotics, as rising wages put pressure on the costs of manufacturing firms, and more importantly, as companies try and gain greater control of their supply chains. Cloud computing and cybersecurity, companies are really starting to see the benefits of using the cloud, allowing them to access information online from anywhere on any device. And there's still plenty room for growth here. On the back of the surge in mobile communications, the Internet of Things and cloud computing, the importance of digital security has risen drastically, especially now with so many people working from home. Healthcare innovation, innovative healthcare technologies are receiving a lot of attention. Robotic surgery, genome sequencing, healthcare trackers, and artificial intelligence will continue to transform the sector. Diagnostic data will also be used more to minimize and avoid health issues going forward. Fintech and e-commerce. Global fintech revenues are expected to grow from $120 billion in 2017 to $265 billion in 2025, or 10% per annum. This is about 3 times faster than the broader financial services industry, such as banks and insurers. The global e-commerce market is worth almost $3 trillion. However, this is still only around 15% of total retail sales worldwide, and this will continue to rise at a rapid pace, especially if COVID hangs around. Digital entertainment and education. This theme includes various forms of entertainment such as video and music streaming, social media, gaming, augmented and virtual reality, as well as internet advertising. It is forecast that the global video streaming market will double in size to $73 billion between 2019 and 2025. On clean energy, renewables made up 25% of global electricity generation in 2018. That's expected to rise to 45% by 2040. Finally, on smart mobility, nearly every car manufacturer and major supplier has an autonomous vehicle project in the works. The autonomous driving tech market is predicted to grow at over 30% a year between now and 2023. So what have we seen unfold in the past couple of months? Well, quite simply, companies that play into these themes have benefited greatly during the pandemic. As I mentioned at a previous webinar, we have actually seen some shares that play into these themes reach new all-time highs despite what is going on. None of these themes are new. They were identified long before COVID. The outbreak has merely accelerated adoption. Microsoft CEO Satya Nadella has characterized the crisis as 2 years of digital transformation taking place in the past 2 months. The graphic on this slide is quite startling and gives a good idea of what has taken place. Video conferencing company Zoom has seen its daily active users increase from 10 million in December to over 300 million subscribers in April. It is now worth more than the world's 7 largest airlines combined. Zoom's share is up over 150% this year, whereas American Airlines, Southwest Airlines, and Delta Airlines are all down more than 50%. The other key point to make here is that by having an actively managed portfolio or investment, you should have done much better than investing in a passive ETF that merely tracks the market. If your portfolio was positioned in the right areas, you would have done much better. More importantly, how are we positioned going forward? First of all, we believe in having an actively managed and diversified portfolio of 20 to 30 stocks. It is more important than ever before to do your homework before investing. There's no need to try and be fancy. You would have done very well by simply buying and holding the right companies. We remain focused on identifying the companies that are best positioned to benefit from the long-term investment themes and are still favoring the stay-at-home winners, such as e-commerce, streaming, gaming, and cloud computing, despite relatively high valuations. There's nothing to suggest that these themes will become less important once the pandemic is over. And it certainly appears that technology's deeper penetration into our lives and work is here to stay. Valuations are demanding, but we are happy to pay up for companies that are likely to continue doing very well and with higher revenue and profit visibility. However, we did take some profits recently as these stocks have run very hard. And we are also looking at some stocks that we believe have been unfairly punished. We are also overweight defensive sectors such as healthcare and consumer staple stocks. These sectors have fared better than the rest of the market and will continue to do so if we do see the market sell off. We are underweight industrials, but we are looking at increasing exposure to industrial automation stocks. As Mike alluded to, recessionary periods tend to speed up the process of labor automation as routine jobs and functions are replaced by machines and software. Further automation and artificial intelligence will enhance the resilience of supply chains. We are overweight US equities. The Fed has basically said that it will do whatever it takes to try and get the economy back on track, and they are in a better position to do this compared to other economies. Emerging markets were already very constrained from a debt perspective prior to the outbreak. We are sticking with the companies that have strong cash flows and balance sheets. These companies are more likely to be in a position to take market share as weaker rivals exit or no longer have the cash required to continue innovating. I've mentioned before what a formidable force the big tech players, Amazon, Apple, Google, are here. They have hundreds of billions of dollars in cash to spend. Finally, we are sitting on some cash to take advantage of potential market weakness. There is still a lot of uncertainty and risk around, as you probably gathered from Mike's presentation. The next slide shows some of the companies that we hold in the portfolio. So first of all, starting on the top left, Honeywell is one of our industrial automation plays. The share has taken a bit of a hit this year, and it is quite heavily exposed to the aerospace industry. However, the company also has a lot of exposure to home and building automation, warehousing automation as well, which we think is a big plus. Gaming giant Activision Blizzard gives us exposure to the surge in gaming demand that we've seen take place, with nearly 500 million active users across 196 countries. Its biggest franchises include World of Warcraft, Call of Duty, and Candy Crush. The share's up nearly 70% over the past year, so it's done really well. Medtronic, one of the world's largest medical technology companies, operating across more than 150 countries. The share is still down this year, but we still believe it's a great med tech stock to have. The company's medical devices are used to treat nearly 40 medical conditions, and it served over 75 million patients last year. Nestlé's defensive nature has resulted in it outperforming the rest of the market recently. Its size provides procurement advantages, increased shelf space, as well as a difficult to replicate distribution network. Louie Vuitton, one of the world's most valuable luxury goods companies and one of our all-time favorites. They gave a sales update last month, and sales did decline in line with expectations due to the coronavirus outbreak. However, the group's outlook for the rest of the year was actually very positive, and the focus of the result, especially in terms of the recovery that they're seeing take place in China. Amazon is still one of our big holdings. We did reduce our position slightly prior to the company's Q1 results, which were released at the end of last month, as the share was up nearly 30% in April alone. While sales growth exceeded expectations on the back of high demand for e-commerce, profit did miss expectations as expenses ratcheted higher. This did cause the share to sell off. However, it's recovered all of those losses, and it's our best performer so far this year, up around 30%. Visa, the world's largest payment technology company, reported a strong set of results recently. COVID has had a very negative impact on the business in the short term, but the longer term positive is that it has accelerated the transition to electronic payment, as the crisis has forced a temporary switch to more electronic and online activity. And finally, Microsoft's Office products have never been more important. There are now over 250 million commercial Office 365 users worldwide on Outlook. Microsoft also reported results recently and saw very little impact from the outbreak. On the next slide, I just give a very brief overview of how you can invest offshore. So Sasfin, you can either open up a global share portfolio, so a global equity portfolio. We also have an innovation portfolio, which is more exposed to higher risk tech stocks. And there's a lot of exciting opportunity. It's smaller tech companies that we think there's a lot of room to grow. We also have a multi-asset strategy available in dollars, pounds, and euros. And then we have our global equity fund, which I'm involved with. And that's all from my side. Errol, back to you.
Thank you very much, gents. I'm going to dive into some of the questions here. There are some tricky ones, but I'm going to throw them at you anyway. I think, Mike, the first one's probably going to be for you. So we picked up quite a few timing questions, if I can call it that. So some of them around. I'm sitting on a fair amount of cash. When is the right time to start investing? Global versus local. If you haven't taken money offshore yet, given where the rand is the timing right? So perhaps just share some of your thoughts around investment strategy when thinking about timing in terms of what markets have done and in terms of where the rand is and etc.
Thanks, Errol. I think the first point you might remember the first global theme was all about the sequential lockdowns and the sequential unlocking, and then obviously the staged recoveries. We're in the recovery phase. Yes, the level of infections are very high, and there is the uncertainty around a second wave once you start to unlock the economies, but we're actually on the right side of the curve now. That's the first point. The second point is that the kind of both monetary and fiscal response to all of this has been enormous in the developed economies, mainly because they've actually had the firepower. Whereas with emerging markets, you haven't seen anything like the same amount. And even if you were to strip our 10% down, 10% of GDP down at 500 billion, not much is coming out of the actual fiscus itself. So it looks to me like the advanced economies are probably going to come out of this thing better. They'll have certainly much higher debt levels. The interest rates are going to be a lot lower. And I do think that what it's done is it's actually created more differentiation. So let me take a step back. So yes, although I think the rand will strengthen slightly, I think there are enormous risks in the next 2 years in this country as we start to unlock and cope with the kind of debt levels that we're going to have. And really importantly, the point that Nick made was that actually your investment universe and the ability to plug into some of these new trends that have come about because of the innovations created out of necessity with COVID, you're not going to find inside this country. You're going to find them offshore mainly. So my sense is that you to progressively carry on investing, not because you don't like South Africa, but because there are opportunities you can't get in South Africa, you can get into the international markets. And it is a very volatile time. So trying to get your timing right, I think, is nigh impossible. To me, the sense is to actually decide it's probably a good time to do it now, yes, but to do it in tranches, not to try and get your timing for one big tranche, but to do it progressively over the next 18 months as a medium-term type of strategy.
Yes, thank you, Mike. I think maybe just to add to this, and I think that these timing questions have come up literally, I think, in every single webinar that we've hosted, and they're very difficult. And I suppose just to add to that, we very much subscribe to the notion that the best is to stay invested. Right? Don't try and time the markets. Over the long term, it really just is noise. And yes, there are structural shifts here, and certainly there are opportunities to switch into quality and those types of opportunities. But trying to time markets doesn't work. And if you're sitting on a lot of cash, absolutely, it's about taking a phased approach, because the reality is everything we're talking about here is about long-term trends and themes, and to call where the rand's going to be a week from now, 2 weeks from now, or a month from now is literally impossible. Mike, I think that just leads on to another question that came through, I'm going to really just ask. We've been fairly negative in terms of some of the comments around South Africa, and for someone who's wanting to support local, what is there room for optimism in South Africa given where we are right now?
You're going to have to pick your spots very carefully. If you look at what's happened I mean, one of the reports that we're planning to do in the near future is just to look at the major companies, or the major companies in big industries like packaging, like steel, like construction, and see what's actually happened to the major companies in this country. If you'd been invested in ArcelorMittal, you would be having a couple of cents in your share price now. If you looked at Nampak, you've taken an almighty pasting. Murray and Roberts is not a fraction of what it used to be. There are companies that have held up. The dual listeds are obviously an important one. I do think some of the commodity stocks, as long as the mining charter doesn't get too aggressive, some of the commodity stocks look quite interesting. The platinum prices and the PGM basket is starting to look quite interesting. The industrial side looks like it's having a very tough time. And I'm not entirely convinced that the industrial side is a good place to be. One of the big problems, and this comes back to more of a macro kind of thing, is that if you look at the empowerment policies in the country, basically it's empowering companies that are moving around the JSE, not through the JSE. So in fact, I mean, if one goes back, I mean, when I think back to when I started as an analyst in '85, back in 1990, there was a stunning array of companies, big companies that you could invest in. You've got a very small universe to invest in your local side now. So the NASPERSs, the processes, etc. And one of the big issues that I do have, and I come back to one of the themes that we talked about with the global balance sheet restructuring. I wonder how many of the dual listed companies will say, well, we haven't got any assets in South Africa anymore. Why are we dual listed in South Africa? And that those dual listings could change. So my sense is that that we're in for a pretty tough time. I do think tax rates are going to go up. I think as Alec pointed out, we went into this thing in a very tough position. We're going to come out in a much tougher position. So trying to, expecting any kind of decent, forget about double-digit growth in earnings in the domestic industrials and financials for the time being. That's just not going to happen. But our banking system will be supported. The SARB will support the banking system. Yes, it might have a tough time, but if the banking system goes down, the whole country's gone. So that the banking system will be there long after many industrial companies have fallen over. So my sense is that some of the big companies are the ones that will be able to ride these big waves in the domestic system. And I would be, unless I really understood a small company well, trying to play little niches in this environment is extremely difficult, and a lot of them you can't invest in. So one needs to stick to the big, really well capitalized businesses.
Thank you, Mike. There was just a question here around, how does fleeing capital impact local equity prices? I'm not going to hand that over. Obviously, that it is negative. We do rely on foreign investors into our market. But then just going a little bit to offshore, there's just a question. I think, Nick, this is probably best suited for you. Asking, how do you find potential winners in areas like artificial intelligence, big data, etc., when one can't even be sure that a lot of them will still be around? Quite a crowded space, and a lot of jargon gets thrown around in this area.
When you hear, a lot of these themes and these terms being thrown around, you tend to think that, okay, the only companies that are playing in these spaces are small tech companies that are highly risky, and might not be around for much longer. But that actually isn't the case. A lot of your older industrial companies are getting very involved in the space. And why it's good to support them and why it's good to back them is that they do have the market leading positions and the client bases already that they can work on and transfer over to more automated solutions. So the one example I gave was Honeywell, which is I think it's nearly a century old. It's not a new tech company, but they've just done an excellent job at transforming the company to play into these spaces. Another one that we own is Siemens. Also, one of the oldest industrial companies in the world, and they have, they've got their whole digital factory division now focused on automating factory floors. So it's not necessarily saying, okay, well, you need to go into a small cap tech play that's playing and taking advantage of artificial intelligence or using artificial intelligence. A lot of the established companies are already doing it, and also the big tech companies as well. They've got lots of exposure to the AI side of things. So by buying a Microsoft, a Google, you also can get exposure to AI and artificial intelligence through those companies.
Thank you, Mike. I think you touched on this, but maybe I'm going to pose this question to Alec. Just going back to banks and the comments Mike was making earlier, we just had a question come through that, given the big move or hit that we've seen in the local index, do we believe that they are poised for a recovery over the next 3 to 5 years? Is it a good place to be?
To answer that question, I think as Mike pointed out, the banks will be supported by government, and they are unlikely to fall over. But that doesn't mean that their earnings are going to be tremendously impacted. I think the COVID pandemic and the debt that so many consumers have actually been forced into, and businesses have been forced into because of this pandemic, is really going to put a tremendous amount of strain that you've already been seeing on non-performing loans, on credit write-offs by the banks, that it's going to put a lot of pressure on the earnings performance of the banks. So yes, the banks will still be around, but we don't expect very much to come in terms of performance because of the pressure of non-performing loans, and with very, very low economic growth and low investment by the private sector and government sector. There's very little demand for debt as well. So their credit extension is going to be under pressure, and that puts pressure on their profitability. So my outlook on the banks is very much like the outlook on retailers, for instance. It's very much driven by economic activity, by consumer activity. And with those under pressure over the next couple of years, I don't see very much upside for the banks.
Thank you, Alec.